Welcome back. Today I want to look at this question from May 2018 on question 4b about the cash flow. So we have been given the following financial statements for Olekina Limited for the year ended 30 March 2018. So we have the Olekina income statement as well as the balance sheet. So as you can see, the revenue, costs of sale, distribution, administration, the received and what is paid, so as the tax. For the financial position, we have been given for 2 years. So we have the assets for 2017 and 2018, property, plant, equipment, intangible asset, investment. Then you also have the current assets, inventory, receivable, short-term, cash in hand, and total assets. Then we also have the equity and liabilities. We have the equity, share premium, liberation, as well as the retained earning. Then you have the non-current liability. You have the loan, current liability, trade payables, bank overdraft, tax, and equity. Remember, we are going to utilize the indirect method if we have not been told. And then we also have the addition information. During the year, the investment classified as non-current asset was sold. The proceeds of sale for this investment amounted to 15 million. We have the fixtures fitting. Their original cost was 42 million. The carrying amount of 22 million were sold for 16 million during the year. And the following information relates to property, plant, and equipment. You can see the cost, accumulated depreciation, carrying amount. Then you also have the 2.5 million ordinary shares for sharing terrain per value were issued during the year at a premium per ordinary share. So dividends totaling to 40 million were paid during the year. We are told statement of cash flow in accordance with the International Accounting Standard IAS 7, statement of cash flow for the year ended that first. So since we are not being told, we go with the indirect method, which is mostly advocated. So let's go to the solution. But before that, I would like we start with the workings, so that we can understand the PPE movement schedules as well as all the working capitals and as that. So let's continue. So here are the 5 supporting workings that I have undertaken so that you can be able to work with the cash flow, since we need to have the adjustment ready. So we are going to start with the PPE. I have just simplified it so that you can be able to understand. So we have the opening from our figures and addition informations. So from our opening, we have in 2017 it was the cost, it was 297, and then we are told at closing we have 360. So that will be our closing. Then for the additions, we have been told that in the same year 2017 we have 145, which was accumulated depreciation. So our net book value at that point was 152. So that we can also have our accumulated depreciation for 2018 we have been given, which is 170. So for the additions, we are going to find them here. We have been given for the addition, I think we have not been given. So to calculate it, we are going first of all to take this note. We have been given that the original cost, so the disposal, it was 42 million, and the carrying amount was 22.5. The carrying amount is the same as net book value. So for the accumulated depreciation, when you subtract that, we are going to get 20. So that will be our accumulated depreciation. Then we also have a depreciation which was supposed to calculate. So we shall leave that first of all we calculate it in our work 2. So our closing depreciation, as you can see, it was 170 for 2018, and that one for 2017, which is 140. So we also have the depreciation, that accumulated depreciation, which we have calculated here to be 20 on disposal. So you have to less the closing plus the opening, you add the accumulated depreciation on disposal, which will give you 45. So our depreciation, when you bring it on the movement schedule, you have to write it there. So to get the additions, since we have the closing amount, so you have to add this 297, we subtract 42, then we from the 360. That's why we are going to get the 105 as our new additions. So we have done working 1 and 2. So for the tax, we are given the opening, which is 70. We have been given to be, let me see, the opening provisions, which is 55. Then you have the expense from our income statement. As you can see here, it's 70. So you have to add that. Then our closing, which is 60. So we are going to understand that our tax paid will be 65. So that is the one that we are going to utilize, as well as 45, which was our new depreciation, as well as this the net book values. Then we go to the working capital movement. So it involves the 3 inventory, receivables, and the payables. So for the inventories, opening, closing 75, we have the opening, which is 51. So the change is 24 there. So that means it's an outflow. Then you also have for the receivable, closing 195, opening 157, you have positive. So the same, that is an outflow. And if it's an outflow, when you come to cash flow, you are going to subtract that. So we also have the payables, whereby we have the closing 63, opening 59. So we also have an increase here, which is 4. So there is an inflow. So we are going to add. So those are the 4 working that I'd like you first of all undertake. So for the reconciliation, that one I'm going to look afterwards. So since we have everything in place, we can start. So we are going to start with the title, the Olekina Limited Statement of Cash Flow. We are going to utilize the indirect method. So for the year ended, so all amounts here are in shillings, millions. So we are going to start with the cash flow from operating activities. So we have we have to get our profit before tax, not after tax. So before tax, we get it is 150. Then you do all the adjustment, the depreciation, all that amortization. Since we don't have many, we have the depreciation for our PPE. We have calculated to see to find it is 45. Then you also have to add the loss on disposals. So the current amount was 22 million. The proceeds we got it is 16 from our question. So we are going to get a loss of 6.5. You also have to add that. Then you also have to add to raise the interest received, the non-operating income. So the interest received, as you can see, we have seen it is 12.5. So you also have to deduct that, as well as we add what was paid to be that 7.5. So we deduct what we received and what we paid. So that is a part of cash operating activity before working capital. So the working adjustment, the one that we have calculated. So from 2017 to 2018, here there is an increase. So we have said if there is an increase, we deduct. So we have to deduct 24 and we deduct 37, as well as here, since there is a payables, there is also an increase in payables. We add. So those are the same cases that we have done. So we less those, so we get the amount. So you have to understand that. So here the difference was 24, but you have to understand inventory and receivable. When they increase, you deduct. For the payables, you add. Then you also have to less the tax paid. So the tax paid here was, we have calculated that in our question to be 65. So you also have to raise that. Then so our net cash from operating activities, when you add all of this, you are going to get 103. Then you also have to adjust for cash flow investment for investing activities. So the proceeds from the PPE. So we have that one that we are given to be 16, the proceed after disposing the PPE. The addition you have calculated to be 105. So we have to raise that. Then the proceed from sale of investment, we are given as 15, the sale of investment, as you can see in our TB. Let me see, in our financial, in addition information, so sale of this investment amounted to 15. So you have also to add that. So you have the proceed from sales of investment, you are given as 15. So here is all about the what we invested. So the net cash used in investing, the total, we get a that one is a loss, negative 74. Then you go to the financing activity. So this is all about the equity. So the issue of ordinary shares, we have been told that dividends totaling known there, we have been given the shares. It is 10 million ordinary shares. Not for 2.5 million ordinary shares of 10 shilling per value were issued during the year, and a premium of 2 ordinary shares. So you have to add this 10 plus 2, so that you get the total shares or the amount. So we multiply by the 2.5 plus 10 plus 2, so it will be 12. So that we get, that is to be 30 million. Then you also have the loan proceeds. For the loan, we started with 25, we managed to get 85, so there was an increase. So we had that increase. Then you have to raise the dividend paid, which was totaling to 40 million in our note 5. So this is our net cash from finance, which is 50. So to get the net increase or decrease in the cash and cash equivalent, we add the three, the operating, investing, and the finance activities. So after we add, we are going to get this is net increase in cash and cash equivalent, which is 103 minus 74 plus 50. So our net increase, it is 75 million. So this is why I wanted we do the reconciliation or proof if we see if we have gotten it correct. So the cash and cash equivalent reconciliations for 2017, as you can see, let me give you the we started with the cash. We have to add the short-term investment, which we had 0, and the cash we had 0.5. Then the payables that we took, we had to pay, or what we were supposed to have, the overdrafts, since that one is in that is our cash equivalent, which was 49. So when you subtract that, you're going to get 48.5. So this is our cash and cash equivalent, our net in 2017. In 2018, we do the same. We started with short term 25. We had 1 for cash equivalent. Then you have to raise the overdraft, which is 42.5. We get negative 16.5. So the actual movement here started from negative 16 to negative 48. So we have an addition of 32 million. That is what we can say, we improved by 32 million. But since our cash, our net increase, as you can see, in cash and cash equivalent is 79, you have to subtract 32. So we have a discrepancy of 47 million. So this one is explained in working 5, which I was saying here. So the working base net increase was 79. For our reconciliation show that we have actual increase of 32, not 79. So the discrepancy of 47 million. So these are the likely reasons that I found. So the PP additions may include the credit on non-cash purchases. We also have the rounding or unreported offsetting adjustment. Maybe working capital includes non-cash movements. There are some those of things that were paid on credit, they are not being told. Tax and interest payment mismatch. So this one, all what we have done is you can say our disclosure is standard in professional reporting, especially under limited disclosure. So we have been given a limited disclosure. But if you have any additional information that pertain this, or you have any scenario that you get not 79 million, let me know. But with this disclosure, we have got all the marks that we need to pass in our exam. So this is what you are supposed to do for the statement for cash flow for this year. So if you have any question, let me know and post it on the comment below. So thank you, and I'll divide this video as well as do each step by your own, and you are going to understand more. Thank you, see you.